Hey everyone, so 8 months ago I released a video titled Lower Risk Safety ETFs with 5% plus dividend yield. It focused on both Canadian listed and US listed stocks, and it got 27,000 views. So obviously there's some interest in safer funds, and just a disclaimer, many of those funds will be featured once again in today's video, but I found others as well, so I'm giving you other options. So I did a recent survey to see what topic you want me to cover next, and this topic, once again, safety ETFs, was the winner. So thanks to all of you who voted. If you want to vote in the next survey, all you need to do is make sure you're subscribed to the channel. So make sure you subscribe. And honestly, the winner of the survey was the safety ETF. So it wasn't really a surprise to me, right? Because the market starting in 2022 is experiencing more volatility than 2021. And if you're a newer investor, I'm sure you're getting a little bit of jitters. This is completely normal, everyone. Trust me, it goes away with time and experience. Especially if you invest the way I do. But I strongly believe that getting the highest possible returns, the highest possible yields should be secondary in priority to do-it-yourself income investors. The first priority, in my opinion, which not many people mention or ever talk about, is mental health. What's the point to get the highest possible returns or the highest yields if you're going to be stressed, if you're going to be anxious, if you're going to have trouble sleeping at night? What's the point of anything really if that's what's happening in your life? So that's the way I feel about it anyways. So in today's video, I will present to you once again what I feel are safer and more stable or less volatile funds that you could invest in to bring some stability to your portfolio long term and bring some serenity in your life if you're a do-it-yourself income-oriented investor like myself, especially if you're a newer investor, doesn't have much experience. So I will focus on Canadian listed funds specifically in this video and release another video next week for safer ETFs on the US market, on the American stock market, which also has some great safety options. So stay tuned for that video if you're American or invest in the US stock market, or if you want some great safety options for your RRSP account. Don't forget, the RRSP in Canada, there's no withholding tax. So this is why I invest primarily on the US stock market, specifically for the RRSP. Now, keep in mind, everyone, before I unveil all the picks here, it's very important that just because I consider these funds more stable or safer, which essentially means they will fluctuate less, right? The stock price will be a bit more stable. They can still fluctuate. So I just want to make that clear. If the market goes down, these funds will also go down, but not as hard as the overall stock market typically. So I don't want you to think of these funds as a place to park your money super safely, like a cash savings account. It's not really for this purpose. There's simply more conservative options, less volatile options for income-oriented investors where you want to at least get 5 to 6% yield, right? So the criteria for all of today's picks are they have to be 5% yield or 5% interest minimum. There are many safety options out there with less than 5% yield, but in my opinion, if you're not getting at least 5%, I'm not interested. I don't want to know about it, but that's just me. So it's important that you do your own research, everyone. Make your own decision on one, if you actually need any of these funds, and two, which one you like best, right? And for the record, I do not own any of these funds right now that I cover in this video, because for me personally, I feel that they're not necessary, but that's just me. If you want to add a little bit more stability in your portfolio because it'll help you sleep better, I strongly suggest to do it. And listen up, because I will cover many funds today. I split them up in 4 categories, so you will be spoiled for choice. All right, everyone. So the first category that I want to focus on for safety ETFs or safety funds are the preferred shares of split funds. So we all know that split funds are called split funds, right? Because there's 2 classes of shares, the preferred shares and the Class A shares. I know I don't talk much about the preferred shares. I'm mostly only focused on the Class A shares where the big yield comes from. But the preferred shares are actually very, very safe and stable funds, because they have all the downside protection, right? So in a split fund, the preferred shares do not capture any of the ups and downs of the portfolio. So it's a very, very, very stable type of stock. And I'll go through a few of my favorite ones today. So I like the QuadraVest ones, but I'll also show you some Brompton ones after. But the QuadraVest ones, what's special about them is that they're monthly payers, right? Brompton preferred shares on the split funds are all quarterly. So the two best ones, in my opinion, is really DFN 15. Dividend 15 Split Corp, which is literally the most popular and biggest split fund in Canada. So the stock symbol for the preferred shares would be DFN.PR.A. It's very important when you look it up, you get the PR in there, which stands for preferred. So this is basically, it's the same portfolio, right? You have classic the best Canadian blue chip stocks, except you have that's very, very strong downside protection. So you're looking at about 5.5% yield with Dividend 15, which is very, very well diversified in terms of sector. But you also have Financial 15. Stock symbol would be FTN.PR.A. There's also FFN.PR.A. But this one here, compared to DFN, only has financial companies. But I mean, if you're looking at the companies, they're all big blue chip companies, Canadian and US. So what makes them really special is the stability of the stock price, because, you know, you could read about it, you know, here, how they, what the preferred shares are all about, but it's you know, very stable. It acts like an actual fixed income security. So it has a downside protection rate. It actually says strong downside protection and asset coverage. So if we look at the stock chart for, let's say, DFN.PR.A, this is actually the 10-year chart, guys. And I mean, it usually always stays, the stock price always hovers around $10. That's just how, this goes for all split funds. The preferred shares usually always trade at about $10. Now, is it possible that during a market crash it goes down? It is. Like we see this is the COVID dip right here, and you see it went all the way to about, what, eight something. So $10 to 8 something is, for a huge market crash, is still very, very, very good. And it quickly went back up to about $10. And now there's a little bit, you know, it's at 973, which doesn't make sense to me. It's probably undervalued, because these things are usually always trading, or their value is always about $10. Unfortunately, the Quadravest website is not really nice. You only see what the NAV is, the unit NAV is. So 1720, this is the net asset value of the preferred shares and the Class A shares together. There is no place to really check what the NAV of just the preferred shares are, but I wouldn't be surprised if it's $10 and the stock price is 973, which means you're getting a good deal buying it at 973. So a little bit the same thing with the Financial 15. Very, very, this is also 10 years, so you could see it hovers around $10 usually all the time, unless there's a big crash, and then it'll go down. You know, this one went down a little bit harder to 750, but it came back up, you know, relatively very quickly after a couple of weeks, I think. So Financial 15, because it's all financials, it's a little bit more, you have a little bit more concentration risk, but you're looking at about 6.5% yield, which is 1 full percent higher than DFN. So really, really good options here if you want some stability in terms of stock price and get about 5 to 6% yield. Brompton has a bunch of others. Luckily for us, they have an amazing website, so you could actually see all their split funds here. In terms of, I'm in the preferred share section. If you click on preferred shares, these are all the preferred shares. You could see once again the PR and all their names, and you could actually compare what the value is, the NAV, so what it's actually worth, to the stock price. And you'll actually see, you know, GDV, for example, which is actually my favorite split fund of all time, the preferred shares, which would give you 5% yield, they're worth 1009, but they're trading for 1099. So there's a tiny, tiny little discount there. Same thing for LBS. So unfortunately, these are all quarterly, so you have to wait for your payout every 3 months. But my top choice would probably be DGS, which is literally DFN's competitor. So it's about the same yield. They both have about 5.6% yield, and it's actually pretty large. I mean, it's worth $10.13, the preferred shares, but you could buy them at 973. Kind of exactly what's going on with with DFN. I mean, they have a lot of the same stocks in them, so I'm not surprised. But just remember that they're all quarterly payouts. So if you don't mind the quarterly payouts, then Brompton has plenty of great options for you. So this is for the first category. If you're asking me my opinion on which one is really the best, personally, right now, I feel that it's FTN, because you're getting great stability and bang for your buck, because you're getting about 6.5% yield, which I find is really, really good, and you still have that stability overall. So now let's check out the second category of funds. All right, so second category of funds would be ETFs that use option strategies, but they use options in a way to reduce volatility. So you have a few options from BMO and purpose. I'll go over the 4 options you have, and all 4 of these funds basically write options on a portfolio of very stable blue chip, big cap US companies. So they're all US focused, which makes sense because the US stock market in terms of options is a lot more mature than the Canadian stock market. So the first one you have here is ZPay or ZPay, the BMO premium yield. So basically it's you're getting about almost 7% yield. You actually see the risk rating is low to medium. So basically it's a portfolio of blue chip stocks, blue chip US stocks. If you look at holdings and look at all the stocks, you'll recognize a lot of them. And this is a little bit different from the 3 next ones or the 3 other ones that I'm going to cover because it's kind of like a hybrid. It does put options. So put options is you're selling the right for someone to sell the stock to you. So you're getting stocks by writing put options, but they also can do covered calls here. So it's literally a combination of the covered call strategy and the put option strategy. So there's another ETF, BMO has a lot of covered call strategies, and they have one that's US focused, and that's just covered calls. So this is, and they also have ZPW or ZPH is the Canadian currency hedged one. So ZPW does not do covered calls; it just does puts. It writes put options on a large basket of US stocks, and they have a covered call ETF. I think it's ZPH if I'm correct here. And they write covered calls, so on a portfolio of US stocks. But ZPay kind of combines them. That's what I'm trying to get out. I'm having trouble getting out. But ZPay basically combines the covered call strategy on US stocks with the put right strategy. So it's very, very stable in terms of stock price. If you actually look at ZPay graph, it's been out since about 2020. It came out just before the COVID crash. So actually looking at the stock chart tells us a lot. So it's about $30. It came out $30, and during the COVID crash, when everything went to hell, the ETF only went to about $27.50. That's the lowest point, $28.75, and then it quickly recovered back to 30. Stayed at 30, 31, very, very stable. And now with the volatility, obviously it makes sense that it's gone down a little bit, but it went from 30 to 28, 22. So very, very stable in terms of stock price. That's what you want. It's not perfect, but for the market to crash and this going only to 31 to 28 and now again 30, 31 to 28, that tells you a lot. It doesn't really go down that much. It's less correlated to the overall stock market. So and you get a really nice yield of about 6.83% now. Monthly distributions, they've actually raised their distributions once from when it came out in 2020. So it used to be 15 cents a share, and then in 2021 they bumped it to 16 cents a share. So I don't know if they're going to bump it up again, but very, very stable. ZPW or ZPH only does the put option, so it has higher yield at over 8% now, but the stock chart is less impressive. I mean, you could see that there is kind of a downward trend, and it is a little bit more volatile. But to go from let's look at the COVID here, 16 to 13, and now again 16 to 13, it's really not so bad, right? You're having decent stability with a nice yield, not as stable as ZPay or ZPay, but you're getting a little bit more yield. So those are 2 great options from BMO. Purpose Investments also has 2 options that they do very, very similar thing, except it's only put options. There's no covered calls. So ZPay is the only one that does the combination of covered calls and puts. But the purpose ones just do put options. So you have this one here. The first one is PYF. That's the stock symbol. You're getting about 5% yield, just under 6% yield. And the put options are sold 8 to 10% below market, which means that the put options are not going to be exercised as often if they're closer to the strike price. So it's like they say here, low risk way to generate stable income from equities using our proven options writing strategy. And then if you want a little bit more yield with a little bit more risk, well, they have Pref, which does the exact same thing. But you see the difference is 3 to 5 levels. Puts are sold at 3 to 5% below market. So 3 to 5% compared to 8 to 10%, it means that there's a little bit more risk for these put options, but with more risk comes more yield. So once again, if we look at the stock chart, this is PYF, the first one. It came out in 2016 at $20. Now it's at 17.15. But keep in mind, it's for all these years you're getting about, what was it here, almost 6% yield. But you could see a little downward trends, very, very similar to what ZPW is doing. And it makes sense because it's the exact same strategy on the exact same stocks, big cap US stocks. But PayF has been around only for 2019. And, for a put option strategy that's a little bit more aggressive than PYF and has more yield, it actually looks like a better option in my opinion. You could see from the COVID crash here, $20 to 17, and then right back up near 19.50, and then from 19 to about $18 now. So a little bit more fluctuation, but you're getting more reward obviously with the higher yield. So all great options here, guys. My preference, or my number one choice in this category would probably be ZPay because of its uniqueness that it uses both covered calls and put options. I think that's probably the combination that works best. And I'm happy to announce that I will be interviewing the fund manager who manages ZPay in an upcoming video. Very excited about that. So I'll talk to him about it. I'll ask him how this ETF came about, how it originated, who's it's designed for. So stay tuned for that video. I think it's a really, really cool ETF, and it's pretty big too. It's the biggest one out of the three, even though it's, I think, the youngest one. It has almost 300 million, where the other ones are a little bit smaller, a little bit less liquid. So stay tuned for that video coming up on ZPay. So the third category I want to focus on are defensive sector specific covered call ETF. So we all know that certain sectors in the market, right, are very defensive and fluctuate less. Usually they're called non-cyclical sectors because they don't really have cycles, like the energy sector or the financial sector or the tech sector. These are cyclical, which means some big events or macro events in the world could make them go up or down. Interest rates, for example, things like that. But there are some sectors in the stock market that really kind of stay stable and defensive no matter what. So the two that really stand out to me is always the healthcare companies and the utility companies, right? No matter what's going on in the world, everyone needs their healthcare services. Everyone needs their electricity, their telecom services. So healthcare is really, basically Pfizer, Johnson and Johnson, those types of companies. And utilities usually means electricity companies, so Fortis, Amera, Hydro One, Southern, that's the one in the US, etc., etc. So electricity providers, also telecom providers, Bell, Telus, Rogers, AT&T, Verizon, and also some pipeline companies like Enbridge. So those would be under the category of utility. So in Canada, my three top choices, it's very easy here. HHL would be my top healthcare choice. So this is a covered call ETF from Harvest that only has the big blue chip healthcare companies with an amazing yield of over 8%. It's their biggest covered call ETF, their most popular covered call ETF that just passed $1 billion. So very, very liquid, very, very stable. Their distributions have not changed since 2015, which is absolutely incredible. And if you look at what kind of stocks they have, you'll recognize most of them. These are all the big cap blue chip healthcare companies. So Eli Lilly, Merck, Pfizer, AstraZeneca, Bristol Myers, AbbVie, it's always Johnson and Johnson, United Health Group. So it's always the same, really. There's only like 20 or 30 of these big cap giant pharmaceutical, and it's not just pharmaceuticals, it's also healthcare providers and stuff like that. So very, very stable sector. You'll get 8% yield here. Of course, you'll have to look at the stock price, right? It's not like you'll get less fluctuation, but you will still get fluctuation. Because these are still stocks, it's still equity. The second choice would be utilities. I absolutely love them. You have it literally right here, income and stability. So a very, very stable sector, a sector that's known to be stable, that's known to have good dividends. So it's a great theme to do covered calls on, right? Because you have the dividend income, covered call income. So you'll get a nice 7% yield here. So and a low management fee because this is actually passive. It's one of the lower management fee, only 0.5 Harvest ETFs. Really, really like it. So if you look at portfolio, you'll recognize a lot of the companies, and this is really global. This is the strong suit of HUTL. I'll show you BMO's utility one in a second, but if you look at the geographic allocation, which for some reason is not coming up right now, portfolio, let's try that again. There we go. It's you have really, really good regional diversification, right? So you have the best utility companies all over the world. You have, AT, you'll recognize a lot of them: AT&T, Bell, Enbridge, Emera, Thales, Verizon. So it's all electricity companies, telecommunication companies. So very, very stable companies, very, very stable sector. You'll get a nice 7% yield here. BMO has their own as well. ZWU, one of my favorite BMO covered call ETFs. ZWU, by the way, is one of the 7 ETFs in HDIV from Hamilton ETF. So it's just utilities, but unlike HUTL, it's only North American utilities. So it has basically pipelines, and here are the 3 biggest pipelines in Canada right here off the bat: Pembina, TC Energy, Enbridge. You have electricity companies like Fortis, Exelon, Southern Coal. So this is just Canada and US. And of course, you also have telecom companies: Bell, Telus, Rogers, AT&T, etc. So another great defensive sector fund here. You're looking at about 7% yield for both of these. And listen, I'm going to give you also a gold one, although I prefer the utilities one. If you're someone that really thinks of gold as safe and stable, there's actually a physical gold covered call ETF. So these are not gold producers like Barrick Gold and Newmont. That would be HEP from Horizons. They also have this one right here, the Horizons Enhanced Income Gold Producers. This is even safer. HGY, this is just gold. It's just physical gold. That's all it has. All it holds is one of the biggest ETFs that holds physical gold, but it writes covered calls on it. So you get monthly income off of this. You get about 6% yield, which is really, really good off gold. So this is, when people say I have gold bars, what do you think of buying physical gold? I say at least get HGY. Okay, it's physical gold, but they're writing covered calls on it, so you're getting something every month, whereas gold bars, you're not getting anything. So these are the options for really sector-specific, defensive sector-specific covered call ETFs, where although the price will fluctuate, of course, of the fund, much less so, because the stocks inside these funds are very, very defensive: healthcare, utilities, and actual physical gold. If you ask me which one would be my top choice out of these, it'd definitely be the utilities one. Which one between HUTL, ZWU, I can't choose. It's up to you to figure it out. They're both really equally as good. All right, last but not least, the last category of safer or less volatile funds I want to cover are real preferred shares and corporate bonds. So this would probably be my least favorite category out of the 4, but I'll give you some options anyway. So unlike the split fund preferred shares, those are not actually preferred shares. Remember that. That's just preferred within the structure. It's not actual preferred shares. If you actually want legit preferred shares, I would suggest 2 things. One, go with the US market, because the US market in terms of preferred shares is much, 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 much bigger than the Canadian market. And 2, there is a really special US preferred share ETF that I found that has some leverage. So I'll show you that in a second, but I'll give you the 3 options in my opinion that are the best ones. So ZUP would be from BMO. This is the BMO US preferred share index. Very, relatively stable. Keep in mind, preferred shares are still equity. It's kind of like a hybrid between bonds and stocks. So you have less fluctuation. It acts more like a bond, but the prices still fluctuate, right? So you're just getting a little bit lower volatility, more stability. But hey, you're getting about almost 6% yield here. In Canada, you would get less than 5. There's not many good ones in Canada, so I would stick with the US one. And here you really have, again, a low to medium risk rating. Low management expense ratio, only 0.50, and you basically have just a mishmash of preferred shares all over the US. You have the sector allocation here. Of course, most of them are going to be financials, but you have a bunch of other sectors, all United States. So ZUP would probably be my top choice. How big is this thing? 64 million. It's not that big, surprisingly. But another cool option for preferred shares would be Brompton. Brompton has a really cool closed-end fund, which they recently converted into an ETF. It's called the Brompton Flaherty and Crum. I always have trouble with this. I actually did you're going to see a video coming up, an interview with the ETF vice president at Brompton. Really cool. We talk about this ETF, but basically this is a US preferred share ETF, very similar to the holdings of the BMO ones, and you'll get about the same yield, 5.36, but they have a leveraged version So BPRF is non-leveraged. BEPR is literally the same thing with a bit of leverage. So you're getting 8.35% yield. I thought that was very interesting. So really cool. I love high yield. So I would, this for me is probably the best option out of the three, because you have basically US preferred shares with a bit of leverage. So yes, with the leverage makes the stock price fluctuate a bit more. So keep that in mind. So, and if corporate bonds, I'll give you an option, ZJK from BMO. So here you have high yield, high US yield corporate bonds. So again, kind of like preferred shares, a more stable or it's under the fixed income umbrella. So a bit more stable than stocks. Really good yield here of over 6%, really good, and all the best US companies, and basically it's company debt, it's corporate debt, so it always has priority, or it has more downside protection than the actual stock. So here are a few options for preferred shares and corporate bonds. I would say this is my least favorite category, to be honest. I prefer the first three categories just because I think the options are great there. But hey, if you really want legit preferred shares or corporate bonds, these are some great options for you. So there you have it, guys. 4 categories, lots of choices within each category. Once again, it's up to you to do your homework, look at the stock prices, decide what's most important for you. Is it really stability? Are you okay with a little bit of volatility to go for higher yield? So there's investing is not black and white, right? It's what's best for you. It's not what's the best. It's what's best for you that counts. I'll continue to say that. So here are a few options. Make your choice and enjoy the added stability that this will bring to your portfolio. Thanks for watching, everyone. Really appreciate it. Please show your appreciation by hitting that like button. It's free for you. It takes 2 seconds. It helps the channel grow. It helps get the message out. So it's a win-win. Also, if you like this type of content and you're not subscribed yet, make sure you subscribe. Hit that little bell button so you're notified of any upcoming videos. You don't want to miss them. And make sure to check out our website, passiveincomeinvesting.ca. That is where you could access a bunch of free tools and resources. You could download my portfolio, my monthly stock pick report card as well. And of course, that is where I offer my digital product that I'm very proud of, the ultimate DIY investing package, which is on version 3 right now. You only have to buy it once. It comes with lifetime updates. My plan is to do an update at least annually. So version 4 is scheduled to be released in Q3 of 2022. So stay tuned. It's going to be a really cool update. So this product is really to help you build your own portfolio no matter what your investing goals are. So it's not just tailored for income investors, but there's also sample portfolios, for example, for growth, for dividend growth, and income as well. So it's a really cool product. It's really designed to save you time on research of all the crazy great funds there are out there. There's so many of them, so many ETFs out there. So this product will help you think of it kind of like a reference tool or reference guide to help you build your own portfolio. I also offer a one-on-one coaching session. It's right there on the homepage if ever you need more personal one-on-one touch, where you could ask me all the questions you want and I could assist you best I can. Keep in mind though, this is not a financial advice or financial planning session, because I am not a certified or a registered financial planner. This is just a regular lifestyle coaching session where you could ask me all the questions you want and I give you my opinion based on personal experience. Also, we have a Facebook page, over 11,000 members now. We are very strict about letting people in. We try to get rid of the scammers and bots right away. So it's a very cool group where everyone is sharing their experiences, asking questions. So make sure to join us there. Passive Income Investing is the Facebook group name. We're also on Instagram. We don't use it much, but we plan on putting more personalized stuff on Instagram. So make sure you follow us if you want a little bit more personal stuff on our everyday life. So once again, the mission of this channel, my mission will always be the same. It's to help ordinary, regular, working people invest on their own. Do-it-yourself investing in order to build your own stream of passive income, to enhance your quality of life and become financially independent, to become financially free. So as usual, stay safe, stay healthy, and of course, stay passive. See you next time.